Welcome back to another episode of Economic Realities and Market Manipulations with your old friend here from Boss Economics World. Grab your coffee, because today, we're diving into the murky underbelly of global finance. Now, it's no secret, the mainstream media tells us one story, Wall Street spins another, and the government? Well, let's be real, they're often just trying to keep the whole system from imploding. Today, we're tackling everything from Wall Street skeptics whispering about recession to humongous corporate mergers, faltering CEOs, and state-sponsored golden visa purgatories. Let's not forget India's space program and the surprising push for the internet's final frontier. But don't expect the usual sugar-coated analyses. No, we're going deep, connecting dots, and giving out some hard-hitting truths that both financial professionals and you, dear viewers, need to understand to make sense of the chaos. Let's start by acknowledging that Wall Street lives in its own alternate reality. Right now, two camps are battling it out, the recession screamers and the optimistic bulls. On one side, you have the doomsayers clutching at tightening corporate bond spreads, stretched equity valuations, and record-high gold prices like they've just discovered the apocalypse. And honestly, they're not entirely wrong. Corporate earnings are being squeezed, and inflation may be down. But down compared to what? Let's not forget that ordinary consumers are still dealing with prices that surged in the last 2 years. Yeah, inflation might only be at 3%, but that's 3% higher on top of the previous spikes. There's no evolution in salaries to match it adequately. Meanwhile, borrowing costs, thanks to elevated interest rates, are beating the daylights out of small businesses and average consumers. Now, let's look at Nancy Tengler, one of the optimistic bulls raising the flag of consumer-driven robustness. Sure, she oversees about $1.4 billion at Laffer Tengler Investments, and she's pushing people into munis, utility stocks, and electrical equipment makers. She's betting on corporate earnings surprises. Tengler believes consumers still have spending power, and she might have a point given recent retail reports, especially in consumer staples. But here's the bigger picture: if corporate growth is supported only by consumer spending, while wages stagnate and personal debt skyrockets, how long can this momentum really last? Right now, the stock market's valuations are sitting at about 27x forward earnings, S&P 500. Historically, this screams overvaluation when compared to the median P/E ratio of 16x, 18x. And fine, bulls might argue that new sectors, like AI, tech, and healthcare innovation, warrant higher premiums. But let's think beyond just corporate profits. What about household debt, which is nearing an unprecedented $17 trillion? Student loans are back. Credit card debt is over $1 trillion at an all-time high, and let's be honest, wage growth simply doesn't offset these burdens. Interest payments are through the roof as the Fed refuses to lower rates in the foreseeable future. Think this is sustainable? Nancy Tengler might, but I wouldn't bet my life savings on it. Next up, let's examine the buzz surrounding Cigna and Humana. Here we go, two gigantic health insurance bureaucracies toying with the idea of another merger. Why? To create even more monopolistic control in a healthcare system that's already financially tormenting most Americans. After merger talks in 2023 fell through because Cigna didn't want to pay the price, they've revived them. Now, word is, Cigna is itching to sell its Medicare Advantage business, supposedly easing operations before rekindling this corporate romance. Humana's stock goes up while Cigna's drops. But what does this deal really mean for the average person stuck in America's broken healthcare system? Let's break it down simply. More consolidation means less competition, which means smaller companies will struggle even more in an already suffocating industry. Patience? Well, don't expect premiums to go down, and lobbying efforts will only get stronger because the government's already cozy with big pharma and big health insurance. Americans pay about twice as much for per capita healthcare costs relative to other developed nations. If you've navigated the system lately for anything from general checkups to emergency surgeries, you know there's no end to the billing nightmares. For Cigna and Humana, a merger might help them streamline operations at the executive level, but make no mistake, the bulk of savings won't trickle down to consumers. Expect fewer options and a further escalation in premiums. Regulatory oversight? Laughable given the number of government officials on revolving doors between the private and public healthcare sectors. Attention at CVS has shifted after their new CEO, David Joyner, took over from Karen Lynch, who was unceremoniously kicked to the curb. Joyner's internal memo asking employees to help fix the operational mess at CVS is both telling and concerning. When the CEO of a major healthcare conglomerate turns to employees publicly for aid in solving financial missteps, you know something's rotten behind the boardroom doors. But here's the bigger issue, CVS, once thought to be an unshakable retail and healthcare powerhouse, is faltering amid unprecedented competitive pressures and its failed attempt to move into healthcare services. Like many companies that expanded aggressively during the pandemic boom, CVS overextended itself, making risky acquisitions just to realize that execution wasn't going to be so easy. And this points to a broader trend we're seeing in healthcare conglomerates. Most are bloated, inefficient, and overly reliant on acquisitions to fuel growth. When organic growth isn't possible, what do? Acquire. But if you're bleeding from within, external acquisitions aren't going to help. And don't be surprised when you see increasing layoffs or attempts to trim operational fat at CVS. Expect further cost-cutting measures to surface, but at the expense of frontline employees. The systemic issues within CVS and the industry won't change. Let's shift gears internationally. Poor Renhai Wang, the guy moves $380,000 to Portugal, investing in an apartment under the glamorous Golden Visa program, which promises investors a path to European citizenship. Fast forward 3 years and nothing. He's still in limbo, one of thousands trapped in the endless bureaucratic sludge of the Portuguese immigration agency. Portugal, much like other EU countries, has tried to woo foreign investors with golden visa programs. This attractive mirage seemed to promise a quick and easy path to residency in return for real estate investments. But now we're seeing its Achilles heel. These countries simply don't have the bureaucratic capacity to handle the influx of investors. Applications are delayed, often forgotten, and foreign investors get stuck in illegal entangles. It's another classic example of governments overpromising and underdelivering. Think twice before jumping into these fast-track programs that sound too good to be true. Renhai could have gotten a better deal in other countries, but the lesson here is vital: do deep research, and don't trust hollow governmental promises. The excitement over Wall Street firms diving into crypto just keeps getting juicier. BlackRock, yes BlackRock, is pushing for its money market digital coin, the BIDL token, to be used as collateral for crypto derivatives trades. You heard me right. BlackRock, the world's largest asset manager, is opening the floodgates for crypto to go even more mainstream. While crypto purists might scream corporate corruption, there's no denying the train has left the station. Institutional penetration into the crypto space is deep, and BlackRock aims to capitalize on this momentum. However, what doesn't get discussed enough is how this institutional backing isn't without risks. Those of you thinking that this institutional involvement implies stability, think again. Any market involving endless derivatives contracts spells speculation over reality, disaster. Paging the mortgage-backed securities crisis of 2008, anyone? BlackRock's smart enough to insulate itself from these potential risks, but retail investors always get the short end of the stick. The wider acceptance of leveraging digital assets effectively removes the decentralized dream the crypto world was built on, and don't be shocked if these tokens turn into more structured speculative tools that leave average retail investors handing off risks they don't fully comprehend. Finally, let's look at India, which landed near the moon's south pole recently, becoming the first nation to achieve this feat. Unlike Western media's patronizing coverage of India as the scrappy underdog, we're witnessing the country's actual rise as a true global space power. The South Asian giant's private companies are playing major roles in this surge, fast-tracking India's road to space and beyond. Space tech is quickly becoming a profitable frontier for nations and corporations alike. As governments collaborate with private firms to tap into space's potential for future mining operations and resource extraction, we're not just talking about planting flags on alien soil anymore, we're talking about real-world geopolitical and economic shifts. With India landing near the moon's south pole, they have opened the doorway to potentially harvesting ice water, which is key for future space missions and lunar outposts. But there's a bigger story here that we cannot ignore: India's rise as a technological and economic superpower. The country, long overshadowed by China's dominance, is rapidly positioning itself as a future hub not only in space tech but also in digital innovation, manufacturing, and renewable energy. Whether it's public-private sector initiatives or startups working with ISRO, India's space agency, India is increasingly recognized as a leader in space and other frontier technologies. Let's pivot to another massive global economic issue that's quietly reshaping the world as we speak: the race for the next billion internet users. It's an often overlooked but pivotal development. Silicon Valley bigwigs like Google, Amazon, and Meta are all salivating over one of the last few untapped markets: billions of people across Africa, the Middle East, and Southeast Asia who are either unconnected or barely connected to the internet. About 3 billion people, nearly half the world's population, don't have meaningful access to the internet. Some argue these unconnected billions are at risk of being left further behind in the digital revolution, widening the gap between the haves and have-nots. But tech companies, of course, see something more opportunistic. new, untouched consumer bases, data goldmines, and prospective markets to sell services like cloud computing, social media, e-commerce, and digital payments. But don't think they're doing it out of the goodness of their hearts. The rise in internet penetration will accelerate the commercialization of untapped regions, inevitably adding more volatility and uncertainty to both local and global markets as companies jostle to out-monetize each other. Remember Facebook's much-hyped Internet.org initiative? It was supposedly all about bringing free internet access to developing countries, but it came with a sneaky catch: users were restricted to using Facebook services or a subset of approved ones. This wasn't free internet. It was a carefully curated ecosystem aimed at swallowing up new users before they even knew how the broader digital economy worked. Meanwhile, competitors like Google expanded their Google Station project, offering free or cheap Wi-Fi in train stations across India, intending to snatch up data, eyeballs, and emerging digital consumers. But here's where it gets interesting: these tech titans aren't just battling each other, they're battling local governments, startups, and sovereign digital ambitions. Think of it as the new digital imperialism. Today, it may look like benevolent investments in broadband access and cheap smartphones. But make no mistake, the real aim is dominance over digital infrastructure, the foundational tech each country will rely on for decades. The deeper question is, as more of the global south comes online, who controls the digital infrastructure of these emergent economies? Local governments and private sectors want autonomy, but big tech aims for dominance. We've seen this playbook before: heavy investment followed by eventual data colonialism, where user tech behaviors, private data, and digital markets are controlled and manipulated by a few Silicon Valley entities. So, don't be surprised when off-the-grid regions start getting hooked into hyper-commercialized, predatory online ecosystems. Let's not forget the risks of unsustainable debt traps. African countries in particular have frequently been offered tech and infrastructure credits by conglomerates from China and the West. They're sold as growth opportunities, but most end up ensnared in opaque contracts pushing future generations into economic bondage to foreign creditors and digital overlords. Now, let's zoom out and tie all these disparate economic realities together. What do Wall Street stock market forecasts, corporate mergers, digital colonialism, and India's rise in space tech have to do with each other? In a word, interconnectivity. The global financial system and technological sphere have never been more entangled, but they've also never been more precarious. Some analysts are desperately clinging to the idea that we're in the midst of an unstoppable bull run, while others, smelling the rot beneath the surface, are bracing for economic disaster. Both arguments have merit, but neither provides a complete picture. Let's break it down. Despite some positive economic indicators like robust employment numbers and consumer spending, other structural cracks are deepening beneath the surface. The former financial regulatory apparatus that could check dangerous bubbles and speculative risks has been dismantled or neutralized by the politicians and corporations that benefit most from temporary market optimism. But bull arguments using employment rates and consumer spending to prop up the narrative fail to address how heavily leveraged this growth is. U.S. household debt has surged to $17 trillion in 2024, fueled by rising credit card usage at record interest rates and the return of student loan burdens after COVID-era moratoriums. There's an illusion of prosperity, but it's held up on a tightrope stretched over crumbling infrastructure. Meanwhile, corporate profits are increasingly driven by fewer players at the top. Megacorporations are consolidating not just within sectors like healthcare or tech, but across the board, creating behemoth entities insulated from competition but exposed to systemic risks. Ever heard of too big to fail? Well, this time the risks are spread even wider, into developing markets, space industries, and digital ecosystems. So when markets pull back, and folks, they will pull back, the effect will be massive and ripple through every corner of the global economy. But we can't discuss all this macroeconomic insanity without acknowledging the giant elephant in the room, the global debt crisis. Perhaps the greatest risk that no one's talking about, or at least no one in power is taking seriously, is that around $300 trillion in global debt is making the entire financial system incredibly fragile. Government debts, corporate borrowings, and individual loans are at unsustainable levels, but central banks believe they can just keep kicking the can down the road. Debt rollovers work until they don't. This isn't a problem just limited to developing economies. The problem is massive even in the developed world, where Japan's debt-to-GDP ratio tops a staggering 250%, and the US isn't far behind, having hit $33 trillion in national debt earlier this year. With central banks raising interest rates, the cost of servicing these debts will only become more burdensome, which reduces funds available for social programs, infrastructure investment, and crucial research and development. Simply put, the bill is coming due and no one has the money to pay it. To summarize everything, we're at a critical juncture in the global economy. The optimists will argue that recent growth indicates more prosperity ahead, increased consumer activity, government backstops, and corporate earnings surprises supposedly signaling a longer bull run. But let's be real here, the underlying structural fragility of everything from equity markets to ballooning global debt, corporate consolidation, and the shifting geopolitical landscape cannot be ignored. The US economy, Europe's persistent stagnation, China's real estate implosion, and rising debt are all components of a perfect economic storm. It's driven by complex dynamics but ultimately propelled by a question we always end up asking here on Boss Economics World: who benefits from all this, and who gets left behind? The global elite have found ways to hedge their bets. They've loaded up on digital currencies, properties, and stocks in sectors that aren't immediately impacted by the day-to-day fluctuations. But ordinary people, they'll bear the brunt of the eventual downturn. Whether we experience a sharp correction or a long, drawn-out recession, the foundations of global capital are about as solid as a house of cards. So, stay sharp. Watch the markets, read between the lines, and most importantly, prepare for volatility. Whether you're an ordinary worker trying to protect your pension or a seasoned finance professional looking for the next strategic investment, remember, this economy is rigged, and it's rigged against you. Make sure to like, share, and comment. Subscribe for more insights into how the system really works and what you can do to protect yourself in a world where one bad policy move can ignite a global catastrophe. Until next time, I'm your host, breaking down financial fictions one episode at a time. Stay skeptical.